Hello, chart watchers and Decision Point faithful. Welcome to this Monday, March 16th, 2020 Decision Point show with your hosts, Carl and Erin Swenlin. For those of you joining us for the first time, welcome to the show. We hope to have you back every week at 5 p.m. Eastern when we are live. But we are not live this week with coronavirus. We're having to record our shows and change some of the air times. So bear with us and keep a close eye on the StockCharts TV schedule. All right, so what are we going to cover today? Well, I think it's all apparent to everybody that we are in a bear market, I would say. And Dad, I know we were talking a little bit about real estate. I just recently sold a home, and it was an investment property, but I could see the handwriting on the wall. Thankfully, it is closing today. Couldn't be a moment too soon. How's everything going up there in your quarantine space?
Yeah, I'm self-quarantined over here. Wondering how I'm going to get a haircut next week.
Yeah, I know what you're saying. I actually think I'm going to take my chance. I have a hair appointment tomorrow.
I know.
And the gray just has to go. I don't know, but we'll wait and see if they do stay open.
I know your priorities. I remember during the LA riots, you were driving out to get to a hair appointment.
Yeah, actually, I was, and as Mom will recognize and tell me, I was about, I don't know, what was it, 7, 8 months pregnant?
Oh, yeah.
And LA riots broke out. It was before cell phones. I had a nail appointment. And so, you know, they closed the base. I'm like, excellent. I can head to my appointment early, headed up there. And of course, no one could get a hold of me. The base got on lockdown and everything else. And I'm up there, have no idea, just, you know, but it worked out fine. I got home. There was no issues. And I couldn't understand why everybody was so worried until I got back to the base. Saw the guys walking around with their guns.
So your priorities are in order, that's for sure.
Always. Well, right now, I guess the priority is checking out this market and telling people what we think and what to do. And we were chatting about it before the show. And today, I think we will be doing a lot of chatting because I think there's just a lot going on. And we're real people too, thinking about what's going on, et cetera. So, I know for me, I've had a lot of people asking me, my personal friends, what do I do right now? What do I do? And when I tell them, which is move to cash if you haven't already, they always look at me quizzically and say, but we're at the bottom, right? I mean, my broker, everybody's telling me it's a bargain time now and that I should just continue to buy. And, I get more shares, more shares for less money. And I said, no, you have to, the money you put in is probably already gone 2 days later. It's not worth it. Why ride out the storm? You'll have more cash at the end. But they just look at me and they ask my advice, but they have no interest in taking it.
Right.
None. They just want to be told that what they're doing is all right. And I'm not giving them that message. So hopefully those of you out there are ahead of the game and are in cash. If you aren't, I know for me, I was selling into strength, when we were starting to get those moves to the upside. I've been recommending that in my diamonds reports. Obviously pretty hard to find some diamonds in the rough right now.
Oh, yes.
Yeah, I mean, the scans are coming up zeros. So at this point, I'm trying to find little pockets of strength, places where you can, build a watch list. These are the, find those stocks that may appear to be bargains now and put them on that watch list, and they'll become even bigger bargains, in my opinion. But looking at the DP scoreboards, at this point, everybody's going to say, well, wait, we have green in the long term. Except for the Dow, of course, which had a PMO sell signal on the monthly chart. But all of these signals are in great jeopardy right now. The long-term trend model, that's going to change when we get a 50, 200-day negative crossover. And of course, with a rally like we saw and a bull market like we saw, takes a long time to close that margin between the 50 and the 200-day EMA. And
the diamonds had we're not talking about DecisionPoint time is. We're talking about the DIA ETF for the Dow Jones Industrial Average Surrogate. It did have a death cross today, 50 crossing down through the 200 EMA.
Oh, wow. Let me see. I can get that chart up right real quick here. And there you go, 50 crossing below that 200.
Yeah.
You can see the giant margin that had to be covered by that 50 to get down there. And I think that's why, we're seeing those golden cross indexes not quite there yet, not quite in the sell space, I guess.
The problem with the moving average crossover models is that the let's say when the market's going up, the harder it's going up, the more space gets between the moving averages, so it takes more downside to get a crossover.
Yeah, exactly. So you can see now, though, that golden cross indicator is finally starting to hit oversold territory. We've been watching it and it's just taken forever. And I would say the reason why is like we were just showing you, when you get that kind of margin between a 50 and a 200-day EMA, even if, you get these crash moves, it still takes time for them to come down and get that negative crossover. But I think we're going to start seeing this particular indicator fall even further.
Right.
I'm going to just take a quick peek at the broad markets and then the global markets, and I'm going to hand it over to you to show us some of the charts you're looking at right now.
Okay.
So this is my broad market index. Actually, I want to get a better one because I have, this is in my DecisionPoint live chart list, which is actually free right now on StockCharts. You just go to your dashboard, go to articles, look up DecisionPoint blog, and you'll find a link to this live chart list. But this is one of those charts that I wanted to show. So in pink, I like to use pink for my percentage moves because it's really clear for me. We're down almost 30%, 34 on the equal weight. You've got the S&P 400 getting close to 40% lower. Of course, the small caps are already 42% lower from the high we saw. And you can see that with the Dow and the NASDAQ, both down 30% or more. So this is a lot more than we have seen in the past.
Don't leave that chart.
Absolutely.
Okay, the notice on the S&P 600, it's really our recent highs was not the all-time highs. The all-time highs came at the beginning of the, I'm sorry.
Correct.
Yeah, in the middle
Well,
of
the most recent, the all-time high isn't even on here.
So it's more like 50% decline from all-time highs.
Yeah. See, I think this little green line up here, I think I did have it set up for the all-time high for our IGR, and we've yet to see it.
Yeah.
Okay. The other one I want to look at are our global markets chart, just to give you a feel for the hurt that is being spread around. The German DAX is down from its recent high, 41%. Canada, almost 35%. UK, 41%. French CAC, 42%. Nikkei, 31%. India, 32%. And Shanghai's a little hard for me to measure here because it's been so flat. If you go back to that 2018 high from January, I believe that was their all-time high.
Can you switch that to a 3-year chart?
A 3-year chart? Absolutely. We might lose some of these percentages looking right, but we'll see. Yep, there we go.
You see a number of these markets, the all-time highs were back at the beginning of 2018.
Right.
So,
definitely something to consider in the mix as well when we look at these charts. When you're looking at a Shanghai exchange, it's really been depressed, for some time through 2018, really moving mostly sideways in 2019. There's the drop from what we saw in 2019's high would actually be less right now. So it appears less hurt, but we know that, it came from, its all-time highs, it's down quite a bit. All right, I'm gonna pass it to you. I know you had some charts that we wanted to look at, and we can talk real estate as well.
Okay, here we go. I wanted to start out by showing this earnings chart again. I know that I've been, I show it regularly throughout the year, and I know people wonder why. And now we're all going to learn why. As the market, when it was at all-time highs, was priced to perfection. Anything that goes wrong can send it over the edge. And of course, coronavirus happened to be the trigger this time, but it could easily have been something else, and there may be something else come along. But this totally black swan, I think, on this whole market crash here, because that was not something anybody was expecting. But the thing is, when you have overvalued market, you have no fundamental support under prices. If you were down here, if we had started out down here and the coronavirus had hit, well, we might have had some selling too, but the earnings, the yield on this index would just keep getting better and better, and you just have there has bargains out there you can't pass up when you got solid blue chip stocks. And one of the things that I am worrying about, I've got a control panel that no one can see, but it's right in my face. Let me get it out of there. Okay, I guess I need to switch to the chart in here. I need to update this panel because there.
Yeah, that earnings chart is really interesting. It does remind me of when we were looking at that 08 drop back into value.
Right. Okay, here we're talking about real estate. This is ProShares short real estate ETF. And you notice that right at the middle of February, it hit bottom. And since then, it has gone up 40%. Okay, in 3 weeks, 40%. The real estate is really a hot button of mine because we've been carrying these low interest rates forever. Let me get to the interest rate chart.
There you go. That'd be good.
Yeah, yeah.
You know what? Actually, it looks like we need to go to a quick commercial break, and we will be right back with Carl's chart. All right, we're back, and I'm just going to pass it right back to you. You were talking about yields.
Right. And I need to get that chart up again. Let me do that. Okay, the yield array.
Yeah, so we're talking about problems with the real estate.
Right. Back here, real estate went through the roof thanks to low interest rates in the early part of the 2000s. The bottom fell out of real estate, and then rates stayed unusually low for too long. There was a nice spread between the long duration and the short duration. but now it's just become compressed, and they're just so close together. And this is not, when people were talking about we have the greatest economy ever. No, to me, when you've got a yield array that looks like this, it's totally not a good, healthy situation. And now those unhealthy parts are coming back to bite us.
Well, I know that just your opinion is, with the rates moving low, everybody's talking about racing in to refinance. I've certainly started to look into it myself, and I haven't been in this house but for a year. What are your thoughts on the refinance part of
Well,
this?
on a refi, I mean, if you just refi the balance, I would not say refi, and I'm not an expert, but this is my opinion. I mean, if you can lock in a sizable chunk at the lower rates, that's great. I would not say you should go in and get as big a mortgage as the house will.
Oh, right, to
Yeah,
take out on top of
right.
it.
Yeah, let's not use it like an ATM machine.
Correct.
But so no, refinancing right now would be not a bad idea. But as long as you're just compressing, getting the same amount of money into with a lower interest rate, but no increasing the loan. No.
Right. And we were talking about buying. I mean, right now with quarantines, and we don't know how long that will go. I mean, the real estate market just in general, like I said, I was glad my house is closing. All the signs have gone up, but it's really going to be interesting to see what happens to the housing market, even with the lower rates.
Right. The problem is that the rates go down, and the sellers raise the price to
Accommodate, yes.
right. So you have you don't. In other words, you don't get a lower payment. You get the same payment with a bigger
Yeah, with
loan.
the same house.
Right, for the same house, and that's where it's worked both booms back in the 2000s, and now then in the 2010s, the second boom, and now we're at the top of that, and
Yeah, it reminds me of walking into a car showroom, and they don't tell you to look at the price. They ask you what monthly payment do you want? So basically,
exactly.
oh well, I'm going to buy a house. I can afford to have this kind of a monthly payment. So yes, sellers are going to raise it, and you're going to the car salesman doesn't have to worry about the total cost on the car if you're willing to sell
Well,
for the
that's
lower
right.
payment.
And we'll finance it for 10 years for you. I
Right.
don't know if they're that far yet,
I don't know. I haven't done that in a long time.
but I'm looking at the wrong chart here. I should be looking at this one I'm talking about. This is the ProShares Short Real Estate ETF, REK. And basically, in the last 3 weeks, it has gone up 40%. That's
That's a lot.
that is a lot in 3 weeks. And as far as I'm concerned, my opinion is just starting. Let me just look at the see. This is all that. This has finally hit bottom, and it's going. It's going to be bad.
Yeah. Yeah, and
So,
I think that's just something that people haven't really thought about in terms of real estate.
well, real estate in this last boom, instead of, like I say, instead of the uh, market working out the excesses through losses, like that's normally happens, interest rates were kept low so people could refi, they could basically coax prices back up again. They were too high to begin with, and now they're too high again, and it's going to correct it. The first time we avoided the pain by taking a shot of Novocaine and filling up on opioids. Now we're going to experience the real pain because it's just a horrible situation.
Yeah, absolutely.
Okay, another chart I was wanting to look at. Oh, I know. Yeah, we're talking about real estate, and this is a
Mortgage REIT.
REIT that yeah, uh, Larry Williams pointed out how good a yield it had, and it was around 10% then, I think, about a month ago. Now it's yielding almost 16%. That's pretty excellent.
Yeah.
But it's gone down, and it had to go down 40%. 40%. And
Yeah, I don't think that people have really digested what we're talking about here, especially if they haven't lived through some of those earlier bear markets. I mean, it took a long time to get down to those, 50%, 40%, 58% drops for those bear markets. It took a year or two. This
right,
is this is going to really, this is a problem.
right. And I wanted to I've showed people this before, but this is a monthly chart of the annually, and but it's a total return. It includes the dividends that have been paid out. So it shows you the total return on it. This, by putting an underscore in front of the symbol, we take out the adjustments. So over this, from this high to this low is 70%. That's what happened to if you invested right here, that's what happened to your base investment.
Right.
And I can't think of the term.
The basis.
Yeah, the basis. That's what happened to it. So you're down 70% on what you put in.
Ouch.
Ouch is right. That may come along and be a good one, but I don't think real estate's going to be a good bet for a long time.
Yeah.
So that again, my opinion.
Yep. My investment property turned into an investment because I sold it now.
Yeah, right. That's like, and you have some trades that turn into investments, right?
Exactly.
Okay, I published this chart on in an article last week, but I think now is a good time to take a look at it. I was trying to come up with downside for crude oil, and you really need to go out to get look at the current levels of support. Let's go. This is back to 83. So we've got this was supposed to immediate support right here at about 34, and now we're down below $30 a barrel. We're below 29 actually too, which is incredible. But you got to go back and look and see where the earlier support is, potential support. Right now we've got a lot of congestion in here. Look, I never started my pinpoint there. Got a lot of congestion in here, and so maybe this will do it. Don't know. It's 20 years since we were down at 10. Could we get back there again? Possibly. Very possibly. I mean, this is what's going on now is pretty much incredible.
Yeah. Breathtaking. I think that's really, I was watching today and just watching the market falling, and it just, wow, took my breath away.
Right. Oh, let's take a look at Tesla.
Oh, that's a good one.
Yeah, remember when I was talking about this and I think well, it's up around in here, and I said, this is another parabolic, so watch out. And, you know, I knew it was going to correct some, and it's not what you call a solid blue chip stock at all. So a lot of this is smoke, a lot of it. And so right now, since that parabolic broke, it's down almost 55% from the top.
Hmm. Yeah, it's doing what parabolics do, breaks down and goes back to the previous basing pattern. We're just about there. We're not even there
Right,
yet.
right, right. It's about got to get down to about 299. I think I looked at it this morning. Now, I was looking at DuPont. I'm not sure why a couple of weeks ago, but one of the points I wanted to make is when you're looking at yield, well, this has got a nice 3.5% yield on it. It's a member of the Dow, but then you look at the dividend versus earnings, and there is such a thing called the uh, yield ratio, and it's you divide the earnings into the dividend, and it should come out to be less than 1. And right now, you can see it's probably close to 2. So they're not making enough money to pay the dividend. Therefore, the yield is probably, the dividend's probably in danger.
Yeah.
Just looking at this real estate chart. I'm jumping all over the place, but anyway,
There's just so much going on. We're
right
gonna have to
there
wrap
is.
up here soon, though.
Okay, you'll give me a 2-minute warning.
Yeah, well, you already have a 1-minute warning.
Okay.
No, you're good. About a minute and a half minute.
Okay, well, let's take a look at what everybody likes to look at, technology, and it's down 31% as of today's low.
Right. You know, and you would think, right, consumer staples, everybody's buying out the toilet paper, but, you know, even though those staple stocks are not holding up, nothing is. And a lot of it, I would say, looking at the earnings chart we looked at before, you know, everything's now going to start moving down to fair value.
Right, right. And that's, the last time we had it down there was in the, financial crisis. And it only got the it only got the fair value. It never got undervalued. So we'll see when it gets down about 50%. Maybe it'll be time to buy. We'll be starting to perk up about that time.
All right, you get 10, 15 seconds.
Okay, I'll let you
wrap it up.
take it home. Yeah.
All right. Well, it's been great having everybody with us. I'm sorry we can't record live these days, but we do get our shows on that day that they air. So do stay tuned and watch the StockCharts TV schedule. Happy trading.